So welcome, guys, to the first edition of Affirmative Tech Talk. I'd like to take a moment and just introduce myself. I'm James, I'm a member of the ownership team at Affirmative. I want to tell you a little bit about our company. We've been around for almost 30 years, based in Tampa Bay. Our specialty has always been electronic payments. We started out providing processing software to financial institutions as well as bill payment companies. And over the past really 10 years, we've specialized further in providing risk management capabilities to financial institutions around their electronic payments. So the vast majority of which, of course, are ACH, but we do include other types of electronic payments, and we're going to talk about later during the session how that's a pretty substantial growth area for financial institutions. But our core mission is to help our clients get their data organized. It's often the most difficult thing they can do in managing ACH risk. We help them get their data organized, and then we provide reporting and analytics that enable them to grow their Treasury services business, meet all of the various regulatory requirements. We're going to talk about some of those during the session today. And really provide a very safe and sound model for growth without having to add a lot of personnel, or otherwise enabling our clients to use their people in more value-added ways than compiling reports and demonstrating compliance. So we're going to talk through all that today. I want to introduce our esteemed, highly esteemed panelists. Kim Robertson has been with us for a few years. Kim runs our product. She's our VP of product. And Kim, her passion is in working with our clients. She also leads our implementation group, and she insists on doing that because she wants to make sure that our clients are fully trained and aware of all of our system capabilities. It's also a great opportunity for her to get feedback on how we can manage our roadmap in the future to make sure that our product continues to evolve in a way that our clients find beneficial. Kim is, in addition to being our VP of product, she's also certified Six Sigma Green Belt. She's an APRP, an accredited ACH professional. How many years have you been an APRP for, Kim?
Almost a year.
Wow. And also AFPP, an accredited faster payments professional. So not only do you deal with them, but you deal with them as they get faster too. And that, as I understand it, you were in the inaugural AFPP certification class. Is that correct?
That is correct.
How hard was that test?
Oh, it was very interesting. It was definitely a hard test. A lot of time, a lot of studying. And like one of the things with these inaugural classes is we were the kind of the guinea pigs.
What was the most difficult question on the exam? I'm putting you on the spot here.
So I can't talk exactly about the questions on the
NDA?
exam.
Okay.
We actually do. Yes. So when you go to take these exams, you sign something before they ever even issue the exam to you, stating that you're not gonna talk about specifics on it and give away questions, that sort of thing. However, with this being the inaugural test, there was not as robust of training as study material as there is for like the APRP and the AAP. So it was definitely an interesting journey, and it was absolutely amazing with the study groups that we had and how all of these individuals came together to help mentor each other, help study, and really, we all supported each other with, helping get ready for this test, because we had no idea what to expect because nobody had ever taken this test before. So, in this test, it talks, it goes over ACH, it goes over faster payments, FedNow, RTP, and it's definitely interesting when you're like, I've always been like in the ACH, the wires, the check, the cards world. So really getting in and starting to understand RTP and Fed now, and it's all real time payments, but there's big key differences between RTP and Fed now, and really being able to differentiate on those and understand what those differences are, and even just, the payment codes, right? Not everything is one for both of those, even though they're both real-time payments. So getting to understand that, being well-versed in that now, I feel like that's only going to, help us as we're having these additional conversations with our current clients, with financial institutions out there that's looking forward and looking to move forward in the payment industry with other payment types.
One more, I guess, question to put you on the spot a little bit so the audience can learn a little bit about you. Prior to joining Affirmative, you spent a number of years, I won't say how many, but it was a long time, good experience in financial institutions. Mm-hmm. Managing payment services businesses, payment services areas within FIs, and that has been extremely valuable for us and our clients because not everyone in our type of business, our compliance and analytics software and electronic payments, has people on staff that have actually worked at financial institutions and understand in detail the use case, having applied it. I want to ask you though, what is one thing you're thinking back to your banking days? What is one thing that you miss about working in a bank as opposed to a software company like ours? And then what is one thing you don't miss?
So it's funny you asked that because one of the things I miss is some of the chaos. It's, and I hate to use the word chaos, but when I was actually having a conversation within our team last week, and when we're talking strategies, when we're talking just through different things, a lot of times I'll tell a story about something that I experienced when I was in the FI. And it really helps tie it together with whatever we're talking about internally. And one of the things that we were talking about was fraud. And I got to share a story of how we dealt with some of that fraud when I was at the FI, and something even around human trafficking that I got to specifically deal with in the financial institution. And my days at the FI, you would go from like your normal processing, your ACH pushing payments through, verifying files, but then you could have these crazy things come up where there would be, something crazy, whether it's a love scam happening and you've got somebody trying to wire out or ACH out all their money. You've got money mules coming into the branches, trying to move money, do things. So it's some of that I actually miss because it was always something new happening. And, one of the other things that I did get to share with the team the other day was we were actually talking about the PPP loans. And for anybody that was like in ACH and the whole money movement industry, back in the day when all the PPP loans were coming through, it was chaos because there was so much fraud with that. And it's almost like an adrenaline rush. And a lot of folks that are, really live and breathe the payment industry, you kind of like that adrenaline rush stuff. So that's kind of one of the things like I do miss. Might make me sound a little kooky, but it's just it was interesting to be able to be involved and have all that variety.
What about the other side?
I don't miss the chaos too, because with the chaos comes a lot of stress. Yeah. So it's kind of that trade-off, right? You've got all this crazy stuff happening, and it can be very exciting, right? It makes your day very busy. It's always something crazy and different being thrown at you. But then at the same time, it is a very, very high level of stress because you're dealing with major losses. You're dealing with, all kinds of sets of eyes looking at you, and whether it's executive management, whether it's the board, how you're handling this stuff, how you're managing to that risk. And it can become incredibly, incredibly stressful.
It's interesting. It's good and bad, I guess, in that you miss it and you enjoy it. And now your mission is to be a chaos reliever.
Yes.
So that's it's fascinating. Thank you. Let's introduce our other esteemed panelist, Scott Brown. Scott is one of the, if not the longest tenured employee at Affirmative. I mentioned we were about 30 years old. Scott has shared roughly half of that time with us. And Scott, your background, you are a decorated Marine Corps veteran. You manned I believe it was a 14-man amphibious assault crew during the Operation Iraqi Freedom, I believe. And I want to, so welcome, and I want to ask you to reflect on your time in the service, and what would you say would be the main learning from your time there that you found valuable in your work for us? You serve currently as our CIO. You've had a number of different roles. Started as a systems analyst, I believe, and worked your way up through the organization and spent a lot of time with our clients, helping us solve problems for them on a regular basis. So what lesson or lessons do you apply most from your military experience?
It's a very interesting question. The essence of the Marine Corps is small unit leadership and understanding how to get a lot done with very few people and very few resources, because the Marine Corps is actually a division of the Navy and last on the budget list. So often we had to make do with hand-me-down everything. So you learn to do the maximum amount with the minimum amount of resources. And that really applies to business really well, that you're always trying to achieve as much as possible with as few resources. And I think our clients can appreciate that too, because many of them are in that same situation. So being able to speak their language and understand, that we've been in that position before, both personally and as a business, I think those lessons translate really well.
What, when you think about the Marine Corps, does anyone come to mind as like one of the most preeminent Marines, one of your heroes?
Not really any celebrity. Most of the heroes are just the people that I worked directly with, learned the most from. No celebrity, no one that I could name that anybody else would know outside of that. And that's really, again, kind of the essence of the Marine Corps.
Sure.
It's about who's that person to your left and right and those bonds you build with those people.
I want to say that, this is an extremely, and I think a lot of the people that are audience of this podcast will be Treasury Services professionals, because that's our client base. But there are a lot of people in the banking industry that don't fully appreciate the impact and the power of electronic payments in general, and ACH in particular. So I want to share some statistics. Besides cash, ACH is easily and by far, by a factor of 10, in fact, the largest type of payment. Last year, there were a little over $90 trillion in ACH volume exchanged within the United States. There's about 60 trillion of that, so 2/3 are credits, right? And about 1/3 are ACH debits. And it grows 8 to 10% a year, so it grows faster than the general economy. I mean, by comparison, credit cards are less than 10% of that. I don't know how many to that. I think it's 5 trillion or so compared to 90 trillion. So it's a big deal. Breaking down that 90 trillion in ACH volume every year, 60 trillion of that are B2B transfers. So they're businesses paying other businesses. 11 trillion is consumer bill pay, and then 16 trillion is direct deposits like payroll. So these are the three main areas, and a big part of all three of those are managed by Treasury Services groups within financial institutions. So it's a very important part. When you are in a bank and you run the Treasury Services Group, you're responsible for serving. I mean, you could call them corporate clients, your business clients, your commercial clients. You're responsible providing them with the ability to send money electronically through ACH and also collect through debit originations. And it's really a key service associated with being able to provide banking services to businesses. And there are some banks, financial institutions that specialize more on the consumer side, but I don't know of one that doesn't serve any businesses at all. And there are many of our customers that have a relatively significant amount of their business and their orientation of how they want to generate clients and grow revenue is for business clients. And so being able to effectively manage ACH, being able to run an efficient treasury services business is crucial. And a big part of that is being able to run a good payments program and being able to efficiently process ACH transactions for your clients. And one of the things I want to say is what we believe is that there are some underserved opportunities within the Treasury Services business. Their primary mission is to do this efficiently, to have operating efficiently, to be able to demonstrate compliance with internal and external regulators. Of course, Nacha oversees ACH activity, but there's a number of different regulatory requirements and regulators who are stakeholders in an effective treasury management program. And so you've got to be able to demonstrate compliance with that. You've got to be able to serve your clients efficiently, can't mess their payments up. But then there's also opportunities to generate revenue by serving them, by providing them value, providing them credit for ACH transactions before they clear, or giving them credit in their account to send out ACH credits, right? Or giving them liquidity when they process debit transactions. And we're going to talk about all of that. But it's really critical for Treasury Services to be good at doing that. And then it's also an opportunity to add value. Not just being better at that means you can have revenue generating opportunities. It means that you'll get more corporate clients, which will increase the overall revenue of the bank. So there's a lot of benefits associated with that. And I want to so there's a few different dimensions of that we're going to cover in the call or in the conversation today. But I want to pivot to sort of the foundational issue, and we call it the ACH risk management challenge, right? And I'll ask you, Kim, what are just foundationally, why do Treasury Services groups have to monitor their activity? What's important about that? What operationally, regulatory, what are some of the key requirements of a Treasury Services business and being able to demonstrate compliance? Why is it important?
First and foremost, Nacha says you have to do it. So that's one thing. But Nacha saying that you have to do it and how you do it and, the deep down reason of why you do it, is a whole other thing. So regulatory wise, yes, you're being forced to monitor, but the why behind it is risk management, right? So even though Nacha can give you guidance, Nacha can be very broad in their guidance. And a lot of it's left up to interpretation. So it's left up to the FI to interpret, or for the industry and industry experts to help interpret and give that additional guidance. So that's just kind of one of the big things out there that you got to do.
So it's essentially a regulatory requirement. You can't offer Treasury Services without meeting certain regulatory guidelines from Nacha and also other regulatory entities.
Correct. So Nacha isn't going to be coming in auditing you. It might be the FDIC, it might be the NCUA, just depending on what type of financial institution you are. It's going to be your internal audit team. It's going to be, if you're a part of a payment association and you're hiring them to come in and do, your annual audit and risk assessment, they're going to be coming in to make sure that they're reviewing that you are compliant and that you are managing your risk. And, especially when you partner with, these payment associations, they do two different audits. It's the audit and it's the risk assessment. So the audit is more based around compliance piece. The risk assessment is really looking at the risk that you're taking on as a financial institution and how you're managing to that.
Scott, what are some of the specific regulatory requirements that they have to meet that come to mind? I know there are certain caps on unauthorized activity. Well, what can you share with us along those lines?
Sure. So every financial institution needs to be monitoring both their outgoing and incoming transactions. They have to be able to demonstrate compliance to that. So looking at their outgoing volumes, their outgoing dollars, what SEC codes, methods of authorizations for those payments are they allowing? And then, as you mentioned, on the incoming side, those returned items, specifically, they have to be monitoring their return rate, their unauthorized, so those transactions that went out where the receiver of that transaction said they had not prior authorized that transaction, or any of those that come back for an administrative return code, like account closed. The Nacha set specific thresholds that every financial institution needs to ensure that on a per originator basis, everyone is underneath that threshold, or some kind of remediative action has been put in place.
Now, how does Nacha monitor that?
In addition to the bank producing their own reporting, Nacha does monitor that through reporting mechanisms and then through self-reporting and through a complaint process filed by other financial institutions where they can indicate, to the regulatory body that they believe another financial institution may not be following the rules. They can file a complaint, and then Nacha will launch an investigation based off of that.
And the goal of all that is to have I assume this payment system. It's certainly in Nacha's interest, having created the system, to ensure that it remains robust and trustworthy. And they want people to know that it is sound. And a big part of that is ensuring that, really probably the biggest part, I would think, would be ensuring that people don't process a lot of ACH transactions, specifically debit transactions, that come back unauthorized, which is their focus around that. Is that fair to say? I
would say so.
Yeah. And even though there are certain mechanisms, if I hear you correctly, they oversee, they monitor. They don't come into an FI all the time, but they do expect self-compliance with that. And how do financial institutions provide that self-compliance? Like, I know there are regional payment associations. I know they have internal audit that knows these rules. And talk a little bit about that.
A lot of it is, you've got to have the tools and resource to manage to that self-compliance. So whether that's, you've got a BI team that's doing something, you've got your ops team, you've got your treasury management team, you've got some sort of automated way to put all of this compliance stuff together. You've got to have that in some form or fashion. The Nacha and the auditors do not dictate how you have to do all of that. You just have to have it. And that's kind of going back to what I said earlier about, like, even with the Nacha rule book, it gives guidance, but it doesn't give specifics. So a lot of it's open to interpretation of how the FI wants to manage to this stuff, what their risk appetite is, what their risk tolerance is. As long as they're doing something to mitigate, to it, then when the auditors come in, they're like, I don't care what you give me, if it's, on a spreadsheet, if it's on, a PowerPoint, whatever. They just want to see that you're actively monitoring to this compliance and this risk management.
And what is it fair to say? As I understand it, there are roughly 9,000 financial institutions, including credit unions and community banks in that total. It's down from 15,000 a number of years ago, but it's still a pretty significant number. There's been some consolidation, but there's still a lot. And I think it's probably fair to say that based on our experience, many of these FIs, if not most, are really not aware of their requirements in this area. And that, it's interesting. We'll talk about this too a little bit later, but many of these FIs, that they do more received ACHs than originating. And they historically have really not invested or needed to invest or not had those audits or reviews around how they monitor activity, how they document who's doing what, ensuring that the originators are not involved in any nefarious activity, regulating good payments, bad payments, preventing fraudulent transactions, preventing credit type frauds within the receiving FI. That's changing, right? Because Nacha realized that and has promulgated a set of requirements beginning next year for receiving financial institutions to begin to track and monitor. And so all of this manifests itself both on the ODFI side, the originating financial institution, and the RDFI receiving, in a program that has to exist where certain things are undertaken on a regular basis. For example, originator reviews. There are certain policies in place for dealing with things that have to be documented, but then there's also another set of documentation that's required around here's what we've actually seen when we've tracked, right? And the financial institutions that come to us are often the ones that either didn't put enough resources in there, have grown a lot, and have not been able to scale their ability to do that tracking, and then have gone through an audit or a review and either had a finding that they have to remedy or even a penalty put on them by a regulator for not being sort of more in control of that. Is that fair to say, Scott? I know you've seen a lot of our clients come to us over the years.
Yeah, I would say that's fair. I would say it's a little bit less about that they aren't aware of the rules. Often you'll find there's, someone who holds all the tribal knowledge. That person knows all of the rules and they're pivotal to the whole organization, and they're struggling to scale because you can't rely on a single person to be the source of all knowledge, or that person, God forbid, one day would like to retire. And if they were to leave, that your entire program goes with them. So really it's not about a lack of knowledge, but a lack of ability to effectively apply that knowledge. They just, they have a spreadsheet somewhere.
Yeah.
And that's really where they're struggling.
And that challenge to create that reporting and maintain that. And there's also an interest, many of our clients, their boards or executive management is very interested in this activity. And then, as we'll talk about, they understand it's a very substantial area of risk, like executing debit transactions for your clients carries a great deal of economic risk associated with it. And not just in terms of maintaining the unauthorized rates and the other requirements, but just the potential for loss of principal by giving a client, one of your banking clients, credit to their funds, and then those transactions come back as unauthorized later, and you're not able to recoup those funds, right? There's an economic loss associated with it. There's a great deal. So the financial institutions that find that very important, there's a lot of reporting that has to be compiled. There's a lot of spreadsheets. There's a lot of ad hoc database queries, and this is very sensitive data. So there's a risk associated with doing all that in an unmanaged way. And we really specialize in two things. The second piece is really getting the data organized and into reporting. But the key challenge of managing risk would be just accessing the data. Banks being able to get their own transaction data. Would you talk a little bit about that, Kim? Some of the challenges associated with that and how we help alleviate that.
Yeah, so I've dealt with financial institutions that have, every single core out there. It's an issue across the board. Whether they're in-house or outsourced, no matter what core that they're with, it's a problem with getting their data. And especially if you're outsourced and you've got your core sending your ACH files to the Fed for processing, you don't have direct access to your files. And so, as I'm dealing with these financial institutions and, we're going through implementations, we're figuring out how to source their data, and we're working on understanding their risk management program, because when you're doing your risk management program, you don't need to just be looking at ACH. If you do other payment types, you do wires, you do RDC, for instance, you need to be looking at your portfolio holistically. And that's when you can effectively, manage your risk, because if you're looking at just one key component, that's only going to give you a very small piece. You need to manage that relationship as a whole. So when we're talking about sourcing that data, we're trying to figure out how to source your ACH data, how to source your wire data, how to source your RDC data. And it's one thing sourcing your data, and then it's another thing getting clean data. And one of the things that we've recently done is we integrated with the Federal Reserve. We now have a direct Fed connection, and we can source a financial institution's ACH data directly from the Fed. And the day that we did that, I cannot tell you how my life personally changed, but how we changed the lives of our financial institutions that we're partnering with on implementation, because I now get clean data for the financial institution. We don't have to worry about bad trace numbers. We don't have to worry about poorly formatted files, malformatted files. And that right there puts me over the moon. And it's easy to get. And it takes so much lift off the financial institutions. And it has just been such a breath of fresh air to be able to easily source and get clean data. And it takes the implementation times from months down to 30 days or less.
Yeah.
And, it's really, really important for a financial institution when they're looking for a solution. They don't want to be stuck in an implementation for months. I don't want to be stuck in an implementation for months. And, they want to purchase a product, and they want to get value out of the product immediately.
Let's talk about that, because our specialty, we have this for the majority of our clients, we're able to pull their data down, some of their transaction data through our Fed connection,
The ACH data,
which
yes.
The off-us, I guess, ACH data.
Yes.
And that's really the meat of what they want to be able to track and report on, and we can do that within typically a month. It's really very easy. We have these connections set up, and it allows us to bring our clients from contract signing to value in a very short period of time. But there are other data sources they may want to integrate that aren't available through the Fed. And then there are some clients that there's a cap on the number of transactions. I think it's 100,000
on a daily basis.
Transactions a day, which covers most, but
and that's per routing number too. So if you've got multiple routing numbers, it's.
But I think it's important to note that even if that's not an option, or for the data beyond what's available through the Fed, we specialize in helping our clients get access to that data from their cores. That's a service that we provide. We've been doing it for a long time. We understand what questions to ask. We work with them, hold their hand, and help them set that data feed up so that we can bring that in to alleviate them needing to navigate that unknown murky water all by themselves.
And that is very much a normal part of an implementation when we're talking about these other data sources. If you want to get your on us data, your wire, your RDC, well versed in dealing with all of the cores out there. And the cool thing is we've been through so many implementations at this point. We've been able to develop relationships with the departments over there at these core providers that do this data sourcing. So they've actually become familiar with our specs. We've got great go-to people over there now. I'm on first name basis with some of these folks. So it's made it a lot easier to know that, I can shoot them an email and be like, hey, you got something, coming down the pipeline. Hopefully it gets assigned to you, kind of thing. Right. But yeah.
So that's a big part of it. And the other piece I'll ask you, Scott, when we have a package of reports and dashboards that we provide, on day one and immediately upon bringing in this Fed data that gets our clients, value quickly. And we Talk. I want you to talk through, and this package has been built with the feedback of all of our clients. Each year we've grown a lot. We continue to grow a lot. I think last year we processed through our system over $1 trillion of that 90 total market volume through our system across dozens of financial institutions, all different shapes and sizes. I think we have around 1 million originators and their activity. We can track their activity in our system. And across all of these clients, you and Kim have worked to develop, I guess, what we call a core package that we make available that we believe is the essentials for demonstrating compliance and tracking. Can you talk to what is entailed in that a little bit?
Sure. So as you're saying, we spoke with all of our clients to understand what their needs are and spoke with the payment associations so that we understood exactly what they'd be auditing for. And of course, we referenced the Nacha rulebook, which defines how banks should be managing their overall compliance program. And as Kim said, there's no specific rules outside maybe of return rate reporting of how that needs to be done. So it's not so cut and dry. But we've been able to build a list of industry best practices based on our clients' feedback. And that's really been very advantageous to them. So not only do you get your standard set of compliance reports, your return rate reporting, your volumes, your trends, but also a lot of clients would come to us and say, this is how we're running our risk program. These are the types of elements and the types of reports we're looking for so that we can understand our originator's risk. And when we find trends across the industry, multiple financial institutions, credit unions, banks coming to us looking for the same or very similar things, we say, oh, well, this is clearly a need in the marketplace. We'll then build that report and deliver it to all of our customers so that everyone benefits from this network effect of learning from each other of what the best risk management practices are.
Got it. And that it's always a work in process and evolving. And then beyond that, we have it's important to be able to configure reports and dashboards to specific client needs. They may have unique areas of their business that they want to track and monitor. And an example like that comes to my mind would be we have a number of clients that specialize in third-party payment processors and serving them. I think they're called service providers in the industry. And there's a requirement, they're not one originator. They're many originators, and they need to monitor the activity of their originators, and the financial institution needs to see what's going on underneath that top layer. And so we will often, we have some reporting and dashboards that are specific to that. And just being able to track that is a key, like that's in the data management piece of what we do. But if there are unique reports and dashboards or dimensions that our clients would like to see, we have a team that manages that. I know you work very closely with that team and do a lot of that work yourself so that you can keep your finger on the pulse of where the industry's going.
Yeah. So third-party processor, third-party sender origination is something we specialize in. It is something that is built into our DNA. A lot of other providers might have it as a tack on or it's like an afterthought because somebody brought that business case to them. But that's actually from our founding something that we understood was a need in the marketplace. So it is baked into the core essence of our product offering. So if anyone were to bring us and say, hey, I have a special program, I have a third party, they're doing, it could be any kind of third party payment processor, it could be a payroll provider, it could be a homeowner association, but a collection of originators underneath a single entity. We understand that to the point where we have special reporting baked into the system just to handle those special use cases.
Yeah. That's what would you say? I know you've shared a couple with me. What would you say is one of the evolving trends that you've seen in terms of FIs and what they want to track that maybe they didn't want to track and monitor a few years ago? Anything come to mind? I mentioned it because you said the limit management is an evolving area.
Yeah, that is a good point. So limits are evolving. Financial institutions are really trying to get a better handle around that. A lot of financial institutions would have a third-party program in particular, maybe one or two large clients, which is fairly typical. You would have a couple of large businesses who outsize the rest of the rest of the collection of originators. So sometimes the limits would be set specifically to them, but just monitoring those origination limits, understanding the patterns, the time frames. There seems to be an increased concentration around limit utilization, both on the credit and debit side.
Can I add something to that? So one of the things that I'm continually running across and having conversations on around the limits is how to be more efficient with it. So when you have an ACH origination program, you might have a handful of originators, or you could have thousands of originators. And you've got to assign limits to all of these originators. And, depending on your resources, your sophistication level, your knowledge base level, what other departments that might be involved with, this limit establishment and monitoring, it can become a very complex process. And it can also be incredibly manual. And a lot of times you see a limit picked because you pick a limit. And there's not a lot of data. There's not a lot of historical anything to go off of. And you have to just pick a limit. And when you're just picking a limit, think of the risk that you are bringing into play. And so you have to pick this limit, debit and or credit. And you just kind of got to wait for it to play out.
Well, let's talk. So we've talked so far about the core ACH risk management challenge, the need for demonstrating processes and compliance, and then the hard part of that is getting the data. You brought up limits. Let's switch to that topic and talk about credit and debit limits. We did a webinar on that not too long ago for a couple of our industry partners. Let's maybe talk a little bit about why financial institutions have credit and debit limits in the first place. What's the purpose of them?
Do you want to take that one, or do you want me?
You take that one. I'll add,
Okay.
add some flavor.
Well, you have to have limits. So
What is a limit?
So a limit,
What's a credit limit and what's a debit?
Right. So when you have an originator, if you are originating debits and or credits for them, you have to assign an amount that they are allowed to originate. So if you have a payroll processor and they only originate credits, then you are going to give them a credit amount, which is the amount that they're allowed to originate on a daily or weekly basis, for instance. So, payroll company ABC is my originator, and I've worked with them. I know that on average, they say that they are going to be originating a daily payroll file of $100,000. So I am going to issue them a $100,000 limit, for instance. I am then required to monitor to that limit utilization. So I am going to make sure that they are staying under that $100,000. If they start originating something more than $100,000, I'm going to have to give them that limit exception so they can physically originate an ACH file that has more than $100,000 worth of transactions in it. Reason being you want to have those limits in place is risk management. So you don't want to give them some astronomical limit, say $500,000 of a limit, if they're only originating $100,000 a day. Reason being is you're going to have $400,000 of risk just sitting out there of where something bad could happen, right? There could be an account compromise. Bad actor comes in, account takeover happens, a payroll file is then issued for $500,000 when they're only going to be on average issuing $100,000, there could be a $500,000 fraudulent file that then goes out at that point. So the more that you're in tune with what your originator is supposed to be originating and you're aligning their limits, the better you are at managing that risk, because you're not only managing that risk for yourself, your financial institution, and that originator, but also out to the network. Because when you're in ACH origination, it's not just all about protecting yourself from the originator. You need to be working on protecting the network and those financial institutions that those payments are going out to.
So go ahead.
Yeah, limits are really this Goldilocks zone. So to Kim's point, right, you don't want to set it too high because then you're overextending credit and you're introducing risk. But you also don't want to set it too low because that's going to have a negative impact on you operationally. Customer needs a $100,000 limit, but you've only set them at $50,000, and now files are constantly getting stopped in the workflow. It's causing operations to have to do these over-limit exceptions. And a lot of the time, right, if originator has a 5 p.m. cutoff, they're setting that file at 4:45. The more stoppages you have, the more likely you are to miss that cutoff window. You're not getting your file to the Fed on time. It's not getting processed, and you're negatively impacting that customer relationship. So limits really are Goldilocks. You don't want them to be too low to have the negative impact on the customer relationship, and you don't want them to be too high because then you're introducing risk.
Right. So what I hear you both saying is that there's it's a requirement, right? To be in the program, you have originators. Your Treasury services, you have originators. You've got to have limits. It's a requirement. But it makes sense to have limits for other reasons, because it manages different aspects of risk that the financial institution has. One would be fraud, to ensure that if someone gets access to an originator's account, they can't send out a lot of credits to accounts they have without there being some check in place. There's operational risk, just making a mistake in the file, duplicating payments. So there's a reason to have a control over that. And there's also a credit risk component to that, because that plays in with a service that financial institutions offer to their originators, where they'll give them the ability to send credits without having money in the account. They call that funding a non-pre-funded versus pre-funded account. So a lot of FIs will, the base case would be if you want to send credits out, say your payroll, you've got to have money in the account. The FI puts a hold on the funds and then sends the ACH, and that's called pre-funded. The money has to be there. But the liquidity of businesses, many financial institutions, an increasing number, see a customer service benefit and also an economic benefit, because they can generate fee income from the service, of allowing their originators to conduct ACH credits, originate ACH credits without having the amount, without having to pre-fund, without having the amount in the account, knowing it has to be in there within a certain period of time, or balancing out debits that may come in, knowing that there might not be full liquidity. The financial institution covers that. And there's an economic risk, because if they're not able to reclaim those credits from the originator, they don't put the money in the account or it doesn't show up there, that could be a very substantial loss. This is like a credit card, so for the financial institution, it's a key tool for credit risk management of FIs to have these limits. So there's a number of different dimensions of risk. Is that fair to say?
Yeah, and that's why it's so important to have accurate limits, to your exact point. So you might say, I need to have pre-funding on any account sending over a certain dollar amount. And some institutions will just have a process in place that says, well, what was their highest single day last year? That's where their limit should be set, rather than looking at what is typical for that originator and setting the limit closer to that value. Because if it's much, significantly lower, maybe they paid out bonus checks once last year at a much higher rate. But if they had a much lower daily average credit, origination rate, they might say like, oh, the risk is significantly less for this customer. They don't need to be pre-funded, and that might be much more attractive to the originator.
Yes, and it is interesting you mentioned that, because I'm looking at notes from our the study that we did. So we analyzed a number of our clients' activity in terms of how they set limits and how much was actually utilized relative to those limits. Because unused utilization represents a risk of breakout fraud. It also represents a credit risk. A lot of times, I spent a number of years in the credit card industry and working for Capital One, and we would track our clients' utilization of their credit card. And what we noticed is there would be clients that had a very low utilization, and then all of a sudden it spiked. It got close to 100%, and then they defaulted because that's going to be credit that they use when they're in trouble. They can't get liquidity somewhere else. There's a similar anecdote here, and what we found was in our study of our clients at Affirmative, the average utilization. So across the originators that we tracked, the limits, is to give you a sense of the size of the originators and FIs. They range from $250 limit to $90 million limit. So there was an originator with a $90 million limit there. And the average utilization across the board was 33% for the debit limits. We'll talk about debit limits in a minute. It's a similar story related to why you would want to cap debit transactions that your clients put in the system. And then closer to 40% for credit. But that's a huge amount of unused credit limit. And the other risk, so there's the fraud risk component, there's the credit risk dimension. There's also liquidity risk for the financial institution, because if you're not requiring pre-funding for your really good clients that you want to take good care of, and you have to have the money ready to meet those credit needs, that's a lot of cash you have to hold, and you're paying cost of capital on that. You're not generating any income or benefit in terms of client satisfaction or new clients that come to your FI. It's just sitting there as unused utilization. So a lot of our clients have started to pay a lot more attention to tracking their utilization so that they can more actively manage it. And the challenge in doing that is getting the data and getting it organized and having the reporting, and that's what we help them solve. And through our credit and debit limit monitoring. And then one of the things that we're working on for release later this year is an automated credit and debit limit assignment module that tells them, here's the recommended credit limit based on this client's activity.
Yeah, I'm super excited about that. So to Kim's point earlier, a lot of the time the financial institution is making their best guess because they don't have empirical data to base that off of. So what we're aiming to do now is build a recommendation engine based off the client's past activity so you can know for a fact, based on those transaction histories, this is what that client needs in both debits and credits on a monthly basis. And as those patterns change, as their business grows or if they're cyclical or seasonal and those volumes and dollars ramp up and down, we'll be able to tell you, okay, for December, this is the limit that needs to be for that client. And then you can compare them to the limit they have set. Those that are significantly higher can be raised. Those that are significantly lower can safely be lowered. And you'll know going into the month, exactly where your risk lies and who needs to have a review performed.
Yeah. And we noticed, I think the other thing we noticed was even though there's an enormous gap and unused limit, there was still the tracking, it wasn't tailored enough over time because there was still, I think, 10% of our clients, originators, required limit reviews because it stops everything. Someone's got to log in and look at it, probably at 5 o'clock in the afternoon. It's not automated, and it's not based on the natural ebbs and flows of their activity. And that's where we can help clients get a lot better at what they do.
And one real interesting point from that case study was the bank who best aligned their limits with their customers' actual activity had one of the lowest overages rates. So they were best at controlling their limits based on the customer's needs and had the fewest operational stoppages.
Interesting. Yeah, it was, I'm looking here, 7% of the originators across all of our FIs violated their limits at least once during the month of analysis that we did. And, that is an operation that requires time and it's an operational issue. Let's talk a little bit about debit limits because I just want to cover the base. We talked about credit limits. You know, there's the reasons why FIs would have that. There's the credit risk. There's the fraud risk. There's the operational risk. It's actually probably more acute or necessary on the debit side. You guys want to talk about the nature of debit limits and how they work and why they're important?
Sure. So when a financial institution is setting a debit limit, right? So they're sending transactions out to collect funds, which they're then going to have an offsetting credit to pay the originator for that business. That debit limit's in place to control the amount of risk based on that, what they feel their safety of those debit originations are, that they're going to be able to advance funds to that originator for. And there's a couple of different ways they can control for that. They could control for that through having account reserves, or they could control through that through a settlement window saying, I'm going to offer you immediate funds availability or delayed funds availability based on what we assess the riskiness of those transactions are. And that is what that debit limit's in place to control is at any given time, what's that liability for that payment to that originator.
Because there's an exposure if to the extent the FI doesn't hold the funds and to ensure that there won't be claims against them in terms of unauthorized or NSF. How long does that typically take, that cycle? It's like a month?
So it depends on the type of transaction. An account closure or an NSF transaction is typically 2-3 days turnaround time. But an unauthorized transaction, yes, it's when the account holder notices and reports the transaction. And correct me if I'm wrong, but I think that can be up to 180 days from the time of origination.
There's a long tail associated with that. And the extent to which the FI gives their, which they would need, their commercial client wants liquidity. They want access to their funds. And so the FI has to balance how much do I hold in reserve for them versus giving them credit, which would represent an economic risk to me because if there is an unauthorized claim that I can't recoup from the account, then I have to reimburse the RDFI and the account holder. And so there's a risk that has to be managed. So limits are a tool for managing that risk. Fair to say.
Fair to say. I'm sure everyone knows it, but the ODFI, the originating bank, is responsible for all transactions that are originated and any returns that come back. There is no opportunity to not pay that return. So yes, exactly to what you're saying is the financial institution does have to pay out that return regardless. So there's definitely an opportunity for loss there.
One of the things I wanted to add too is with the limit management, a lot of what we experience when we're having conversations with FIs is it's a manual process of changing those limits. So if you're needing to do a temporary increase, you've got to remember to go back in and decrease that limit after that file has gone out. So it's even more important that if you are making temporary increases from a risk management perspective, you got to remember to go back in there and decrease those limits, or you've got to have some sort of visibility of what those daily limit fluctuations are, because a lot of times, just depending on the setup of your department or the system that you're managing those limits in, one person just may be able to go in and up that limit. It may not be a dual control process. So I would hope it would be a dual control process, but sometimes it might not be.
Interesting.
And if you don't remember to go in and lower that limit, or, Susie over in Treasury Management gets busy, right? There's a fire somewhere, has to go be dealt with. She forgets to lower that limit, and then she's on vacation the rest of the week. There's that additional exposure out there. And that's one of the things that I just see. It's so scary within the industry because it's so easy for things like that to happen. And just it creates that additional risk that's absolutely unnecessary because of lack of visibility on some of this stuff. And it's really, really scary with some of the manual processes that are still being used and are still in play with some of this stuff when really it can be mitigated.
Yeah. So we've talked about In the first part, we've talked about the core ACH risk management challenge. We dove into credit and debit limits, which are a very important feature of risk management. It's a critical tool, a necessary, and then hopefully we've demonstrated also a critical tool for Treasury services departments to be able to manage effectively. And just to wrap that up, like how do we make it easy for them in terms of our reporting?
Sure. So we do automated limit reporting, and we can help in a couple of facets. During the annual review process, most every financial institution looks at both the originator's usage and how that usage compares against that limit. We make that highly visible and easy for a relationship manager to visualize, see, and understand, exactly where that limit and usage fall. And then we also provide automated reporting across the entire program to say, here is your full list of originators, what their limits are set to, and then how much of that limit on a daily, weekly, monthly basis are they taking advantage of, so that you understand how well do you have those limits dialed in compared to what they actually need.
Yeah, and then of course the coming automated limit recommendation engine, and then there's I think, and we're going to pivot now to a more general topic related, just credit risk management that Treasury services groups have to do. And I think this general area is where we are probably the most special and most unique. And it's an area that we've worked as a company to build out over the last few years. And that is leveraging all of the data that we have in our system. I mentioned over $1 trillion in volume, 1 million plus originators across dozens of FIs, all shapes and sizes, very geographically diverse. And we track returns. We track why the transaction was returned. We can characterize each originator, similar to like a credit bureau file you'd get when you went to Equifax or TransUnion or Experian on the originator, right, that our financial institutions have. And we've used all that data to build some predictive analytics to help. We can basically tell our clients which originators have a very high probability of submitting unauthorized transactions, and then which ones conversely have a virtually zero probability. And that plays into our ability to do that at the originator level. And then we can also do that at the transaction level. We predict at the transaction level which transactions are most likely to be returned as unauthor NSF, and which have a very low likelihood of being returned. And those capabilities, those analytic tools that we've built, leveraging the data in our network, gives just an enormous lift to our financial institutions in terms of how they set limits. You can be more generous with limits for lower risk customers on the debit side in particular, and so let's turn to sort of the general concept of credit risk management and why it's important. I believe, and you guys may disagree, I'm interested in your opinion on this, but I believe that the key responsibility for a Treasury services group is effective credit risk management for their originators. And they often do this job in conjunction with the credit risk department at the FI as a whole. But the credit risk group, and I've spent a number of years working in these credit oversight areas, they often don't have the expertise of ACH, right? They deal with different lending areas primarily. This is a unique area. So they rely on their Treasury services partners very heavily for expertise and how to think about credit risk. But why don't you guys, if you could, maybe talk a little bit about the nature of credit risk management and why it's important for originators.
Yeah, and I think with that credit risk management, earlier we talked a little bit about a holistic overview. So to really understand that credit risk management, you can't just look at one component. You got to be able to look at the relationship as a whole. So, and when you're involving, these credit departments, a lot of times they're looking to see if there are loans, if there are credit cards, if there are other bank accounts, right, that originator might have. So I feel like that's a big key component, and I think it's kind of getting into a little bit of that originator review process too, of being able to look at it holistically and make those determinations on how that portfolio is performing and how you move forward with managing that credit risk.
Yeah. A Treasury Services Group, they've got this one dimension of the relationship with a corporate client, right? And that is providing them, it's really, in many ways, a critical one, maybe not the most important, but I can make an argument it is, liquidity
Yes.
to their corporate clients and processing their payments and giving them cash, both outgoing credits or incoming, when they debit an account. In terms of receiving a payment from a consumer or another business. And so they're responsible for this area. But to your point, there's a broader relationship that the FI has. And the reason that they serve corporate clients, business clients, is that they want to make them loans. They want to invest their funds in addition to this liquidity or treasury management. This is a very important area, but there's an aspect within Treasury Services related to credit risk management, the originator, that's critical in that overall relationship. What I mean by that is that if you have a corporate or business client that's processing payments with you, you want to be able to give them, what we mentioned before, non-pre-funded credit options. You want to be able to send payments out on their behalf, their payroll, their partner payments, their vendor payments. You want them to be able to process those payments without having to have cash in the account that day. That's a valuable service. You can also charge a fee for that, but it's a valuable service for the enterprise because it's more likely to bring that customer into the bank and more like them because they have those features. Alternatively, if you're very restrictive and you require that they pre-fund everything, you're less likely. You need to be more competitive in other areas or you're not going to get their business. You're not going to be able to grow your overall financial institution business. There's a very big picture here. On the debit side, being able to give them credit for payments that they process. Provides liquidity to their business that makes the financial institution either competitive or not competitive. If you hold everything for 30 days or you make them have a reserve account beyond that, that they can't touch, businesses don't have a lot of extra liquidity. You're hamstringing them. And businesses will go find other financial institutions that can be more liberal, more generous with how they offer these services. So the key component of being able to do those things for your financial institution, for Treasury Services, being able to do them for your client, is in understanding the credit risk. Because if you are very generous and say, you don't need to pre-fund anything, we'll send out $800 million of payments across the board and not require you to have money in your account, and you lose that money, then you've made everything not worthwhile for the financial institution. You're going to lose your job, right? If you have $100 million or $200 million, $300 million a month in debits that you process for your clients, and you want to give them access to that credit, that money, without holding a portion of it, to be competitive, you have to understand in both of those areas which originators are high risk and which originators are low risk. That's the nature of credit risk management.
And there's a real interesting opportunity that a lot of financial institutions miss out on. So a lot of financial institutions have blanketed rules to say if you're in this industry or if you're this type of originator, you are therefore high risk and you need to have the types of controls in place that you're mentioning, reserves on your account. But if you were to move to a more data-driven model that looked beyond just what industry you're in, but what type of activity are you actually submitting, you will find that there are plenty of businesses who might fall into those categories who aren't actually high risk based on the activities they're performing. And those are businesses that are getting turned away from other financial institutions that you'll then be able to court. You'll be able to offer them attractive terms that are what they cannot find at other financial institutions that will still make you profitable.
That's right. And you can charge a fee for this or not, but you still get the benefit of being competitive, which is probably in the big picture more important than any fee income you might generate, and giving liquidity. And I don't believe, I think if I were to say one thing that Affirmative, what we believe we can really impact in this industry in the future is giving our clients, Treasury Services groups, much more powerful tools for understanding credit risk of their originators and managing it much more effectively than they have in the past. And that our mantra, stay compliant, reduce loss, and grow revenue. Let's say you don't have any losses, like you're so conservative, everybody gets pre-funded, or there's a very small number that don't, everybody has a hold period. That's not necessarily the goal. The goal is to manage that risk. Being in banking, if you take no risks in banking, you don't make any money. That's just, nobody believes like you can run a risk-free financial institution. Managing risk is what being in a financial institution is all like. Maybe whether it's deciding who to give a credit card loan to, who to give a home loan to, or who to give credit to when they process their payments through you. This is the area I believe we can leverage our data, and I see a gap. I see a gap in how that data is used by financial institutions to learn from it, to be able to make better decisions about how they manage their clients. And it's really like the tools are there. So there's the credit and debit limits, there's hold periods. We mentioned all these, right? There's reserve accounts. And this is really about being able to apply those tools with the knowledge, a better knowledge of who they need to be applied to. If the financial institution is too generous, too permissive rather, or if they're too restrictive, it's really that Goldilocks analogy, then they're losing compared to another institution that's smarter about how they use their data and can find an originator that they say, hey, you don't need to pre-fund anything with me because you're good. Or we'll give you next day or same day credit for all of your debit transactions. You can have that liquidity. All you need to do is move all of your accounts over to our financial institution. There's a competitive edge that FIs can get by getting much better about this. And I think that's a big blind spot. My opinion, I mean, there's a lot of smart people in this business, and a lot of our clients are in tune with it and getting there. But I think there's a huge, enormous opportunity across the industry to get much better at that. And we've developed some capabilities and some tools with the data to help our clients do that.
And Kim and I were just talking about this yesterday, is that when you do have an originator who is maybe a little bit higher risk, they've had some higher return rates, and you put them on some kind of remediation program, often the decision you're then facing is get those return rates down, or we have to let this customer go. We have to take them off the board. And through things like our scoring, we could say like, well, let's segment them. Here are your high risk customers, but now let's drill in another level. What portion of their transactions are high risk? Because if you can go and have an intelligent conversation with them to say, okay, you're over these certain thresholds that we're uncomfortable with, but it's these business transactions. If it's a third-party processor, maybe it's just one or two originators, or maybe it's just certain types of activities they're performing. And we could say, we value this relationship, we want to keep it, but this is the activity that we see causing a problem and that we need to decrease. You can maintain that relationship. You can keep, the relationship healthy, keep them as a customer. But without this kind of data, like how would you do that? You're just guessing. Yeah. And that's really what we're trying to solve for, is no more guessing. We want to give people the data so they know what to do.
And I really want to see financial institutions stop having to be reactive and get into that proactive mode. And I talk to so many different financial institutions, whether they're our customers or not, and it's really, really interesting because and I'm going to say we because I was in the financial institution too, but we get bogged down with all of the manual reporting, all of the oh my gosh, what happened last month, right? What happened in this previous month? What happened in the previous 60 days? You're very much bogged down with that, trying to put all that together and analyze it. And you don't have the ability to look at the present and the future. Everything is strictly reactive. And when you're wanting to grow your origination program and you're wanting to have effective risk management, you have got to have the tools and resources in place and the automation in place to stop spending so much time on being reactive. Get all that automated and be able to look at the future and be able to look at growing your program, being able to look at driving more fee income, being able to provide that value to your originators, because the more proactive you are able to be as a financial institution, the better you're going to be able to help your originators, right?
Why don't you talk a little bit about so one of the essential and mandatory, but we don't think you should do it because it's mandatory. Is a good reason. One of the risk management tools is an originator review. Talk a little bit about what that means and how do FIs deal with that today, and then how do we make that better for them?
Every FI deals with it a little bit differently because, again, you have to do one per the rule book, but it doesn't say really how and gives a whole lot of guidance. So when an auditor comes in, they're going to want to see that, you're doing it. But if you have a small origination program, you've only got a handful of originators, you can manually do those pretty easy. But when you are in the thick of it all, you have hundreds, if not thousands of originators and are still trying to grow your program, you are spending all of your time working on these originator reviews. You are going back having to compile manually all of this information of limit utilizations, of return rates, of if they have loans, if they have, account balances, what their origination totals are, what their average amounts are, what their velocities are. And it's all manual, and there's usually multiple departments kind of included in that. People are sharing information. Treasury management may put a lot of the data together, but then they send it off to the credit department for, a review, or they send it off to the originator's account manager for a review. So there's a lot of components involved. It's very manual, very time consuming. So James, tell me, if you have, let's just say 5,000 originators, tell me how your treasury management department, this is kind of rhetorical, but tell me how your treasury management department is going to not only effectively manage risk, but do all of the daily processing, get through all of the 15 audits that you stay in constantly, and then get all of these originator reviews done in a year.
Yeah, it's extremely difficult.
You don't.
You have to have some way of deciding. And what we've seen is either there's this pre-program, here's who needs to be done this month, or is reactive. Mm-hmm. It's here's who had a high unauthorized rate last month.
Right.
And the capability that we provide through our analytic program to our clients is to allow them to shift that prioritization away from the past, reactive as you put it, to being proactive. We'll tell them, here are your high-risk originators. In other words, here are the originators that have the highest probability of submitting unauthorized transactions in the next 30 days. These are the ones that you need to focus on right now. And the model we built, basically, we go back and we summarize, we track activity, and we summarize it in the form of attributes. It's very similar to a FICO score that you would get from a bureau for a consumer that is based on their prior activity and all the other consumer activity they've seen in the credit bureau. They built this predictive model that issues a score. What we do to make it a little easier is we'll give you a risk grade, high risk, medium risk, or low risk. And basically, if it's high risk, it's the very small sliver. And what we found is that the vast majority of our clients, very typical, there are 2% of originators that are responsible for 80% of the unauthorized activity on any given month at any given financial institution. The question is, who are those 2%? We tell you who the 2% are. You go into our system, you pull a list, here they are, right? You can track them over time. You can track your percentage of high-risk originators, how that changes. You can do a lot with respect to that. But importantly, you now know from a credit risk perspective, these are the ones I need to be careful about. And the other side of that is, here are the ones that have virtually 80% that have virtually 0% chance of any unauthorized activity. So those are the ones that I hope you don't have hold periods on that are very aggressive. I hope that those are the ones I hope you don't have very strenuous pre-funding requirements, because guess what? They're going to go to another financial institution that gets smart about them, and they're going to get more liberal liquidity from that. So using that capability, that technology to prioritize those reviews, it meets your desire to go from being reactive to to proactive. And then there's other things you can automate around automatic limit adjustments or automatic hold periods if someone suddenly becomes a high-risk originator. So it's not just about the reviews, it's the other tools or levers you can pull. But all that's available to our clients through the dashboards and the reporting. You want to talk a little bit about how they can access that?
Yeah, so we just offer a platform. It's a single platform where the user is able to log in and then access all of this information. So we don't sell it as modules that they have to separately subscribe to. We say, here's the platform, here is all the insights that we are garnering from your data. They log in, and then there's a series of pre-built reports that they can say, I need to do my compliance reporting. I'm going to go pull my compliance reporting dashboard, access all that information. I'm doing my annual review. I've looked at my originator scores for unauthorized. I found out who those 9 high-risk originators are. I'm going to go to my review dashboard. I'm going to put those 9 originators in, and pull a series of canned reports that are tailored to the risk to share with that relationship manager. What is the activity of this originator? How much risk are they introducing? Do we need to do a review on them? That is how they're going to access all of this information. It's not a lot of setup. It's not a lot of hoops to jump through. It's not a lot of things to subscribe to and settings to manage. We found a way to deliver all of these insights, these KPIs and these metrics and these reports through a single unified reporting platform.
Is actionable. Like this originator report is a very actionable tool that you can take and say, okay, well, now I go have a conversation with my credit department. And I say, here's the justification for lowering or increasing their limits. Or here's a customer we just can't do business with anymore because what they're doing, I need to research them, and maybe I find they're in a very high-risk field I didn't know about. Maybe I find they're actually a processor, processing for others instead of true business originator. So there's a lot of actionable content, and it also enables you to automate your program, right? To where there's a lot of things today you have to do, gather data, get queries, you got IT people involved, you compile reports. We just had a client that met with us, a prospect that said, I want to show you what we do, and want you to tell us how you can automate it. And they do this report. There's one lady, shall remain nameless. She labors at least a week each month just to put a report together. It's 120 pages for their regulators and their board and it's really gathering data on what originator the track record is for each originator. And then it summarizes it in terms of here's our exposure. All that stuff you automate that whole program with Affirmative. And a lot of financial institutions, I think, could benefit pretty substantially from that.
And I think the other thing is that it's not just automating. Yes, it absolutely is automating it, but it's not just saying, here's all of the tasks you're doing today manually, let me automate them for you. It's helping you at a financial institution understand which of these are adding value and which are these that are just compensating controls because I didn't have a way to risk these prior to. Now that I understand where my risk lies, I can stop performing all of these activities on these low-risk originators because they don't need that kind of oversight. I have a risk score. I can now delegate where do I focus those risk-based activities on, so I'm actually doing less of the work but achieving much greater results because it's better focused.
In these departments, they notoriously run lean. So they're generally short-staffed in general. And then somebody's always on vacation, somebody's always having to fill in and help in another department. There's always something going on. So when we talk about this automation, we're also talking about just efficiency because the departments really need these folks that are manually putting all this stuff together. They need them focusing on other stuff. They need them focusing on originator success. They need them focusing on growth. They need them focusing on, other compliance or getting the files out the door in a timely fashion, right? Because you're missing deadlines because of unnecessary manual processes. Like you're not just impacting your department and having operational risk there, but it's reputational risk that comes into play. And executive management is not going to say, oh yeah, we're going to give you 2 more FTEs because you got manual reporting and other stuff. No, they're going to tell you, figure it out, make it work. But one of the other things that I did want to add when, we're talking about this risk score is it's fantastic for originator reviews, but it's also such a fantastic tool for even the board. So all of financial institutions, they in some form or fashion have to report up to the board. And the board is responsible for determining what the risk appetite is. So a lot of times the board members, they may not have banking experience. They may be doctors, they may be lawyers, they may be, current members of the bank in some form or fashion. They may be just other industry people. So you get all different, folks on this board, and when they're having to determine that risk appetite, it's incredibly important for them to have something that's understandable, but also that's impactful and not a 120-page report that they've got to try to decipher through, right? They're not going to have the time, the resource, or the want to go dig through that. So when you can, kind of present to them and say, hey, here's our current portfolio. Here's what we have as far as high-risk originators, medium-risk originators, and low-risk originators. They're able to kind of look at this and say, oh, our risk appetite maybe is a little on the medium to low side. And it's going to give them the tools and resources to be able to make these educated decisions on if they want to take on more risk as a financial institution or not.
Absolutely. And I want to pivot to our last subject, but I want to say we talked about the originator risk score. We also provide the scoring at the transaction levels. We can identify high-risk transactions. And then we also have developed pattern recognition capability to identify high-risk patterns, which we're going to talk about a little bit more in a minute because that's really related to Nacha 26. So let's talk about that. Last topic, very important. There's a lot of hubbub. As I mentioned before, a lot of financial institutions that have historically focused more on the receiving side than the originating side. That big part of their business is not doing business banking or commercial banking, but everyone has to be an RDFI. And now they've got to start tracking their activity more. Talk a little bit about the requirements for Nacha 26, the timing. I mean, what comes to mind in terms of what these financial institutions can expect?
So previously and currently even, because these rules are not in effect yet, you have incoming items. So we're going to talk about incoming first. You have incoming ACH items. They come in. If there's like maybe a hold or something on the account for some reason why the item can't post, it goes out to an exception. It's reviewed by a department, and then it's either manually forced through or rejected back out to the network. And a lot of times that's the extent of what happens around just incoming ACH in general. There has not been any sort of extensive monitoring in place. Comes in, post or doesn't post, you move on about your day. Everything's always been focused around the origination piece. So when talks of this coming into a potential rule change came into play, I was actually really excited to hear about it because it's not shifting liability, but it's starting to put visibility on incoming items. Whether there's a liability shift or not coming down the pipeline, we don't know yet. I would kind of expect it to yes, something be happening on down the road, but it's probably years from now. But again, there's been nothing said one way or the other. But having financial institutions being able to identify irregular patterns or anomalies for incoming items, it's something they really should be monitoring too. And I'm all for it. I think it's starting to share some of that responsibility, and I think that's where we're going to kind of continue to see that shift in the industry as the years pass. But we're one of the things that we're going to be looking at for us with our Nacha 2026 rule change, like reporting that we're going to be doing, is incoming credits. And there's a lot of work that goes into play once fraudulent items post at a financial institution. And so because it's time, it's resources, it's research that has to be done once this stuff starts to happen. And financial institutions a lot of times are oblivious to it because, again, nobody's looking at it. You let it post, and then if something comes up, then you're forced to research it and you take whatever action. So this, again, gives you the ability to be a little bit more proactive. But again, it's also helping protect the network. So if you can start monitoring to some of these anomalies coming in, these odd items, then you have the ability to take action early and return it if you want to. Get it back out to the network. Get it back out to the originator. So that's kind of like my take on the credit piece. Scott, I don't know if you want to talk about the debit piece or if you had more stuff you wanted to add.
Well, I would just say, why don't you talk about, so there's this package that we built for our clients for Nacha 26. And it's, one of the things about being one of our clients that we're always investing in our people, tools, and data, making it better. But we have this vision, and we have a webinar about this that goes into it in great detail. But just at a high level, what's the essence of the initial package of content and services we're building for Nacha 26 on the RDFI side?
Yeah, so a traditional ACH origination engine is often rules-based. Is it over or under the dollar limit? Is it an approved SEC code? We don't think that's going to work on the incoming item side because it's a lot of the time the fraudulent activity is within the account's normal activity of behavior. It's just an irregularity, right? So they might have received transactions before. You can't just say like, we'll flag all transactions over $5,000 because for some accounts, right, that would be irregular activity, but for plenty of other accounts, that would be just daily process. So what you really need to look for is on an account by account or type by type transaction, what is considered normal and what is considered, irregular, and then just identify those items as irregular. So for example, how many tax deposits, credits should be coming into an account on an annual basis? And then how far over that, baseline number before you start flagging those transactions and say, hey, let's take a look at this. Maybe they've just had to file a lot of amended returns. Maybe it's a tax preparer using their personal account for funds distribution. Maybe it is true fraud where someone is filing tax claims on behalf of other people, stealing their tax returns. Those are all three possible cases, but you want to identify those transactions that don't match the normal pattern. If an originator was dormant for an extended period of time and they've started reinitiating, maybe it's a seasonal business, maybe it's an account takeover, account credential scam. But then the real big one is velocity changes. That is, again, is on an account by account basis. What is normal for this account and then what is irregular? And we only want to flag those transactions that are irregular for an opportunity for review. And that's how we're going to be approaching this, is saying what is standard, what falls outside of that standard, significantly outside of that standard, and then identifying those transactions for review.
Right. So a big part of the rules and the language around it doesn't, specify a particular course of action, but there's a concept of fraud management that's woven in, and we talk to a lot of clients, and I think they're. They don't, we try to help, I guess, at least share our perspective that, there's no sort of one dimension of fraud, right? I mean, you have to understand there's different ways fraud can be combated. There are different tools in the industry to monitor transactions for a particular type of fraud. We're in a pretty unique position as it relates to the electronic payment data, ACH data, to be able to see, bona fide transactions versus not, and to get all of this data. And so what we've done in this to accommodate or sort of address this general area of fraud management is look for suspicious patterns because we see all that data. No one else does. We do. And it's the credit patterns is what you mentioned. There's dormant originators that certainly suddenly spring to life. That's a pattern. And then microdeposits.
Microdeposits
Talk a little bit
is
about
one
that.
of them. So a lot of the time you will see deposits under $1, and they'll be properly flagged as account verification, and those are legitimate. But then you'll also see deposits that are under $1, but that are not flagged as an account verification. And that could just be the originator did improperly identify the transactions, but could also be an account testing scheme where someone has purchased a list off the dark web of account numbers at banks. Now they're making small dollar deposits or withdrawals to those accounts, and they're just looking to see which ones of those returns and which ones don't. That is allowing them to validate that stolen list of accounts. So now they've gone from a list of maybe 1 million accounts across financial institutions down to 10,000 known active good accounts. That's a very valuable list for a thief because now they can commit their fraud against that good list.
Right.
They're going to go for the one-time big hit, get the money out, and run.
And these are like critical dimensions of fraud and unique to us to be able to detect. So there's not like a lot of clients' mistakes. I need a fraud prevention tool. It isn't about that. Like there's different areas of fraud, and these are 3 of the most predominant as it relates to what Nacha governs, which are ACH transactions.
Mm-hmm. And it really falls into it's risk-based fraud. Mm-hmm. So
for sure. And then so there's those patterns, and those are in the initial package because we have seen those are the top of the list for a lot of our clients to be able to monitor, and it's a gap. Like there's some other solutions, AML, BSA type capabilities that a lot of clients have but it doesn't meet this particular area or this particular need. So there's that on the fraud side. And then the other area of Nacha 26, it's about just overall governance and monitoring. So talk about the reporting package. This is the other main component. What are the dimensions of this reporting package that we've built out that allow our clients to monitor things they've not monitored in the past?
Yeah, so in the past, like Kim was saying, most financial institutions, or at least many financial institutions, didn't monitor their incoming items at all. So most of them need to just start by setting a baseline to understand what is normal behavior for us so that we know when it's deviating. So we're offering just basic packages to say, here is the amount of funds that are flowing in and out of the financial institution on a daily, weekly, monthly basis. Here are the SEC codes that your account holders are using to authorize those transactions. Here are the other financial institutions on the other end of those transactions and what portion of that volume and dollar goes to each of them. Because there's certain risk involved in that too. Because they might say like, well, we know Wells Fargo, we do a lot of trading with Wells Fargo, we know their practices, they're considered safer than say some other banks. Maybe they're new banks, maybe they're banks who do board riskier originators or have looser controls in place. So you would say, well, any transaction from them with additional rules maybe applied in place, right? I'm going to give additional scrutiny to those types of transactions. So knowing who you're trading with as part of the standard reporting package. And then to what I just spoke to, the anomalies themselves on a transaction by basis, here's the items that we see that are irregular.
It's like sort of it's unique to RDFI, but it's that core documentation and compliance package that clients will need beginning next year. When do the rules come into effect?
2026. So we've got one in March and then in June.
Okay, sort of staggered throughout the year. So
I wanted to add one more thing is, when going back to kind of like the holistic view that I've mentioned a couple of times, when we're talking about this incoming, a financial institution should know not only what they have outgoing, but what they have incoming. You should know if you've got more that's outgoing versus more that's incoming or vice versa, because that right there is going to also help determine your strategic planning of whether you need to maybe source more deposits or you need to change up your origination program. You've got the ability to grow it a little bit more, right? If you've got more coming in that you've got going out and you say, all right, I've got this percentage that we can change to grow our program and have, grow our program by 20% more, then you've got that visibility. You've got that reporting. You've got that, you've got it to be able to show to the powers that be that make those decisions. And so it's really, really important that you have both sides of the data to look at. Because if you're only looking at that origination, it's very lopsided at that point. And you again just need to have both sides of that information. So a lot of the stuff that's changing in the industry, with this incoming reporting, it's going to give the industry the ability to really get that holistic overview if they're not already doing it.
Yeah, for sure. And I think that's like a good way to wrap up, and as we talk through the core challenge, getting the data in, and then the power of that, right? We talked about debit and credit limit management because that's a big tool, but then more generally, we talked about the importance of originator credit risk management and demonstrating, that you have a compliant program with respect to that. And then new requirements in the form of received transaction monitoring that haven't been in place in the past. And the essential message of all of these capabilities, and particularly the newer ones that we've developed around the analytics, helping our clients predict, it really comes down to if you can accurately predict your originator risk, which ones are high risk and which ones are low risk, you enable the most important thing you do for them in processing payments is about liquidity. It's about liquidity management. If you are good at predicting their risk, you can improve their liquidity position. And you can either charge for that and grow fee income, or you become like head and shoulders above your competitors and you can advertise and you can get these clients to come to you and move all of their accounts, not just the Treasury services, but the credit, the lending accounts, the investment accounts, everything else you do for their business. So it's so much untapped potential. So for FIs that have problems with losses, like debit losses, regulatory problems with being able to demonstrate compliance, we've always been the solution for that, right? But if you want to get into a position to grow your Treasury services business and to make it more profitable and really have a proactive, dynamic approach to how you deal with customers and like increase the value of Treasury services within the FI, and you can leverage our ability to help you understand the nature of your client risk, I think there's enormous potential for a partnership there. So having said all that, I appreciate your time, Kim, Scott. Great conversation. Look forward to our next session of Affirmative Tech Talk. I was going to say between the ferns. We are between firms. But thanks again for your time. We'll wrap up. Hope you guys have a great day.
Thanks.
Thanks.